Stop what you're doing for just 10 seconds, because what I'm about to share could decide the fate of your XRP bag. If you click away, you'll miss the single most important piece that explains why the global financial system is standing on a cliff and why XRP could be positioned right at the center of the rescue. This isn't hype, this isn't speculation, this is about mechanics already in motion. Quick disclaimer before we go deeper. Nothing here is financial advice. Always do your own research, make your own decisions, and consult professionals before acting on any market information. For context, XRP is trading around $2.84 at the time of recording, and if you're watching later, the price may have shifted. The point is not the exact number, it's the setup behind it. Now here's the hard truth. The global carry trade, the quiet engine powering markets for over a decade, is sitting on a $10 trillion time bomb. For those who don't know, a carry trade works like this. Investors borrow money in a currency with low interest rates, often the Japanese yen, and then deploy that money into higher yielding assets elsewhere, US stocks, emerging market debt, even crypto. For years, this strategy has been the lifeblood of liquidity, pouring trillions into markets worldwide. But here's the catch. What happens when the cycle flips? When rates rise abroad, when currency differentials collapse, and when that cheap funding suddenly turns expensive? The answer is chilling. Every dollar that flowed in must eventually flow out. It's not optional, it's math. And right now, with the Bank of Japan starting to signal policy normalization, that unwind is creeping closer. Imagine 10 trillion trying to run through a doorway built for $1 trillion. That's the scale of pressure we're talking about. And it doesn't just affect stocks or bonds. It ripples across everything connected to liquidity, foreign exchange, commodities, and yes, even digital assets like XRP. Bond markets are already flashing red. Yields have spiked to levels not seen in over a decade. Liquidity in treasuries, the so-called safest market in the world, is thinning. A single large order can now move prices in ways that used to take billions. That's fragility, pure and simple. And when the world's most liquid market looks fragile, you know the foundation everywhere else is weaker than it appears. Stocks, they're wobbling under the weight of higher for longer policy. Equity investors have been conditioned to believe the Fed always has their back, but the Fed itself is boxed in, fighting inflation on one side, protecting growth on the other. The tightrope is getting thinner by the day. Currencies? The dollar remains strong, but strength at this level breaks more things than it fixes. Emerging markets are bleeding reserves just to defend their currencies. Europe is struggling with energy costs and stagnant growth. Japan itself is watching the yen swing wildly, a signal of just how unstable the core of the carry trade has become. So where does XRP fit in? Let me build the suspense here. Think of the system like a dam. The cracks are forming, the water pressure is building, and eventually something has to give. Traditional pipes, bonds, stocks, FX markets are leaking. But right behind them, new infrastructure is waiting. Infrastructure designed for speed, for settlement, for cross-border flows. That's where XRP comes into the conversation. But hold that thought. Before we bring XRP into focus, you need to understand the scale of this potential break. In 1998, during the Asian financial crisis, the unwinding of carry trades nearly toppled global markets. Hedge funds collapsed, currencies plunged, and that was with far less leverage in the system than today. In 2008, it was mortgage-backed securities. In 2025, the risk could very well be the carry trade and its domino effect across every market. The scary part? Most investors aren't even looking here. Retail traders are distracted by stock tickers and crypto charts. Headlines focus on Fed meetings and inflation prints. Meanwhile, the silent unwind grows louder in the background, invisible until it slams into the front page. This is why I call it a trap. Because liquidity gives the illusion of stability right up until the second it disappears. Just like a lake looks endless until drought reveals the rocks beneath. That's where we are today. Everything seems normal until it isn't. So here's the payoff for this section. If the $10 trillion carry trade unwinds chaotically, global markets face a liquidity crisis unlike anything seen in our lifetimes. And in that moment, solutions aren't optional. They're demanded. Payment rails need efficiency, cross-border flows need speed, markets need tools that can bridge gaps when legacy pipes break. This is where XRP starts to shift from speculation to necessity. Not as a meme coin, not as a side bet, but as infrastructure. Banks and institutions that have already tested it know what it can do. And when the liquidity drought hits, they won't be looking for theory. They'll be looking for tools that already work. Before we dive into how XRP might step into that role, let me leave you with this image. $10 trillion trying to exit a trade at the same time. Doorways jammed, pipes bursting, investors panicking. That's the setup we're facing. And only those who understand the mechanics beforehand will see clearly when it happens. Picture this carefully. The carry trade is not a gentle stream of money. It's a fire hose. And when that fire hose reverses, you don't get an orderly trickle back into funding currencies. You get a stampede. The unwind doesn't move slow. It rips through markets with speed, ripping liquidity out in ways that make even seasoned investors panic. Let's walk step by step through how this actually plays out, because this is where most people misunderstand. First, yield spike. That's already happening. Rising rates abroad reduce the attractiveness of holding risk assets financed through cheap yen. Second, positions start to shrink. Hedge funds and global players, sensing risk, scale back leverage. That sounds safe, but here's the kicker. When everyone de-risks at the same time, they all need to buy yen back simultaneously. That's forced buying pressure, which drives the yen higher, crushing anyone still caught on the wrong side. Third, that yen surge doesn't stay isolated. A stronger yen means weaker demand for dollar assets, emerging market debt, and global equities. Suddenly, what looked like a healthy portfolio becomes a bleeding liability. Margin calls hit. Funds dump whatever they can sell, stocks, bonds, even Bitcoin, just to cover their currency exposure. That's contagion, and it spreads fast. Now pause. Think about the mechanics here. A $10 trillion unwind doesn't just reduce liquidity, it yanks it out of the system at a moment when global markets are already fragile. Bond volatility shoots higher, equity indexes lurch, and forex desks scramble. This is the environment where liquidity buffers become not just helpful, but vital. And here's where XRP enters the frame. XRP's role is often misunderstood. It's not trying to be Bitcoin 2.0 or a speculative meme asset. It's designed to provide liquidity where it disappears fastest, in cross-border settlement and interbank transfers. When banks can't move liquidity efficiently, commerce halts. Payment corridors jam. And in crises, clogged plumbing is unacceptable. What XRP does is create an always-on bridge, an automated market maker that never sleeps. Japan knows this better than most. SBI, one of the country's financial powerhouses, has been championing XRP for years. They've tested corridors, built rails, and prepared for integration with the broader ecosystem. Now connect the dots. Japan is at the heart of the carry trade unwind. The yen is the funding currency. The Bank of Japan is signaling normalization. Who do you think will need tools like XRP the most when liquidity cracks start to widen? The very institutions already aligned with Ripple's tech. And it's not just Japan. The Bank of Japan, working in tandem with Ripple technology, isn't a conspiracy theory, it's a logical convergence. They're already exploring digital currencies, a digital yen. Central bank digital currencies don't exist in isolation. They need liquidity bridges, they need interoperability, and XRP has already been positioned for that role. So let's map the impact out further. Global markets reel from carry trade unwinds. Bond yields spike, equities sell off, currencies whipsaw, institutions scramble for liquidity. Traditional tools can't keep up. At the same moment, payment rails built on RippleNet, corridors tested with XRP, and pilot programs by SBI suddenly become more than experiments. They become lifelines. Here's the midway retention spike. Stay locked in, because this next 60 seconds could be the single most important insight you hear today. Liquidity crises don't just destroy, they accelerate adoption of alternatives. In 2008, banks nearly collapsed, and out of that crisis, Bitcoin was born. In 2025, if the carry trade unwinds into chaos, the adoption curve for XRP could leap forward years in a matter of months. Necessity accelerates timelines. What was once optional suddenly becomes mandatory. And remember, ETFs are coming into play here too. Custodians managing billions will need settlement assets that work across borders, across time zones, instantly. Bitcoin plays one role, store of value. Ethereum plays another, infrastructure for decentralized finance. XRP's role is unique. Real-time liquidity for global money movement. When liquidity fractures, that role goes from niche to essential. But let's not get ahead of ourselves. Go back to the unwind process. The first cracks show in FX markets. Then bonds seize up. Then equities tank as forced sellers dump holdings. Crypto takes a hit in the short term. It always does when liquidity vanishes. But here's the twist. While retail panics and sells, institutions quietly reposition. They look for assets that can both survive and thrive in the new environment. And XRP, with its liquidity function, starts appearing on radars that ignored it before. The choice for institutions becomes stark. Do they cling to legacy pipes that are breaking, or do they plug into a system already built for instant settlement? History tells us they don't cling. They pivot. And when they pivot, the flows are massive. So the question isn't whether the unwind will hurt. It will. The real question is who emerges stronger on the other side. Assets tied to speculation only? Or assets with actual use cases when liquidity vanishes? That's the real frame to see XRP in. Not as a coin on an exchange chart, not as a speculative bet, but as a structural tool in a world where the old system is breaking down. Now let me set the stage for the next section. We've mapped the mechanics of the unwind, the chaos versus order dynamic, and how XRP sits in position as a liquidity buffer. But this isn't theory anymore. On-chain data already shows exchange reserves at multi-year lows. Wallets are consolidating. Custodians are preparing. The shallow lake is draining. And the moment demand slams into that reality, the mask will slip. Let's pull back and look at liquidity itself, because this is where the story shifts from macro theory into something you can literally see on-chain. Right now, XRP exchange reserves are shrinking. That's not an opinion, it's a data trend. Coins are moving into cold storage, into custody wallets, into the hands of institutions quietly building positions. The liquid supply available for trading is thinning, and when demand collides with that reality, the repricing won't be gradual, it will be violent. Imagine a shallow lake in summer. At first glance, it looks fine. Boats float, kids splash, fishermen cast their lines. But below the surface, water levels are dropping every day. The shoreline pulls back inch by inch. By the time most people notice, it's already too late. The docks are stranded, the fish are gasping, and the lake can't support the activity it once did. That's XRP's liquidity story in real time. Exchanges are the lake, and it's draining. Now, layer in the ETF effect. Bitcoin's ETFs sucked up supply at a record pace, creating structural demand with every inflow. The same model applied to XRP would accelerate the drain. Every dollar that flows into a custodied product takes coins permanently out of circulation. Retail investors think about price as a function of charts. Institutions think about supply and demand. When supply dries up and demand scales, repricing happens overnight. That's not hype. That's basic market structure. Here's the kicker. Custody wallets are where the real game is being played. Once XRP is moved into custody with major players like BNY Mellon, Fidelity, or Ripple's own institutional partners, it's effectively locked away. Those coins are no longer part of the shallow lake retail fishes in. They're sequestered into deep vaults where they won't come back onto exchanges casually. That creates a permanent tightening effect on available liquidity. Retail psychology, though, runs the opposite direction. Every dip triggers panic. Every headline stokes fear. The average investor sells into weakness, not realizing they're handing liquidity to institutions at a discount. This is the same pattern we've seen in every cycle. Retail capitulates at the wrong time, while whales quietly accumulate. And when the pivot hits, when rate cuts arrive, when liquidity injections flood markets, retail comes chasing back at double or triple the price. Let me hit you with a retention spike right here. Don't miss this, because it's the single most overlooked phase of every revaluation cycle. Liquidity crunch, utility scaling, institutional dominance. That's the progression. First, supply dries up. Then, as systems demand more usage, think banks running corridors, ETFs absorbing coins, custodians holding long-term, utility creates natural demand pressure. Finally, institutions dominate the order book, building floors retail can't break. That's when XRP moves from speculative volatility into structural valuation. Now here's where it gets psychological. Institutions don't want retail to understand this. They thrive on confusion. They thrive on weak hands. Every piece of negative press, every delay in regulatory clarity, every fear-driven sell-off is part of the shakeout. Because the fewer people holding large bags of XRP when the door is shut, the easier it is for institutions to own the rails. Think of it like musical chairs. At the start, there are plenty of chairs. Everyone's comfortable. But each time the music stops, a few chairs disappear. And when the music stops for the final time, only those who positioned early will still be seated. That's what exchange reserves are telling us right now. The chairs are disappearing. And most retail doesn't even realize the music is playing. Now transition this to what happens next. The phases of revaluation aren't abstract. They're visible. Liquidity crunch is happening now. Reserves dropping, wallets consolidating, ETFs preparing. Utility scaling is next. as real-world use cases like Ripple's RLUSD stablecoin, institutional corridors, and tokenized treasuries kick in. And then comes institutional dominance, a world where XRP is no longer a speculative token but the backbone of settlement infrastructure. That's why timing matters. By the time CNBC headlines are blasting about XRP adoption or ETF inflows, it's too late. The repricing will already be underway. Retail will buy the top. Institutions will have built positions at the bottom. And the wealth transfer will already be locked in. Here's the final tease for this section. If you've been tracking closely, you know what comes after liquidity crunch and utility scaling. It's the phase where revaluation shocks the system so hard, even seasoned investors can't believe it. We're about to step into a world where the shallow lake becomes a desert, and those holding water will name their price. Now let's bring everything full circle and line up the big comparisons. Because this is where XRP's role in the next market cycle stands apart from Bitcoin and Ethereum. Bitcoin has scarcity hardwired, 21 million coins and no more. That alone makes it the digital equivalent of gold. Ethereum has become the backbone of decentralized finance. Smart contracts, DeFi protocols, NFTs, and Layer 2 scaling. Its value comes from network effects and application usage. Both assets are important, but XRP is different. XRP isn't just scarcity, and it isn't just a network, it's infrastructure. It's a settlement layer that plugs directly into the arteries of global finance. That's why comparing XRP to Bitcoin misses the point. Bitcoin can sit in cold storage as digital gold, but it doesn't move value at the scale banks demand. Ethereum can drive innovation in decentralized applications, but it doesn't have the speed or efficiency to settle trillions daily. XRP sits in the unique category of bridge asset, designed to absorb massive liquidity and do it with speed, efficiency, and compliance. And when you look at the macro backdrop, it becomes clear why that distinction matters more than ever. Interest rates have peaked. Inflation, though still noisy, is showing signs of cooling. Global liquidity cycles are turning. Central banks that were tightening aggressively are now preparing to cut. And every single time in history when that pivot occurs, risk assets explode higher. Look at 2009 after the financial crisis. Look at 2020 after the pandemic crash. Liquidity injections light the fire, and assets tied to scarcity or new infrastructure deliver the biggest upside. That's where XRP's structural revaluation comes in. This isn't about hype or speculative trading, it's about necessity. If banks are going to settle cross-border flows, if ETFs are going to warehouse billions in exposure, if tokenized treasuries and central bank digital currencies are going to run through distributed ledgers, then XRP's price must align with that role. A single-digit or even double-digit XRP doesn't work in that system. The liquidity wouldn't be deep enough. The volatility would be too high. That's why so many analysts, from Quincy Jones to Linda Jones, argue that revaluation isn't speculation, it's structural alignment. Here's where psychology plays its cruel trick. Most people won't hold long enough to see it. They'll sell at $5 thinking they've won. They'll sell at $10 thinking they're geniuses. But the true repricing comes after that, when retail has cashed out and institutions take control. It's the silence before the storm, the point where charts go sideways, sentiment turns flat, and everyone assumes nothing is happening. That calm is not the end. It's the staging ground for the reset. And make no mistake, this reset is already being engineered. The plumbing is being built. Ripple's corridors with SBI in Japan, with banks in the middle. East, with partners in Europe and the Americas. These aren't experiments anymore. They are live pilots scaling toward production. The Federal Reserve, the Bank of England, the European Central Bank, they're all studying settlement rails. The IMF and BIS are openly discussing liquidity bridges. And behind the curtain, XRP has positioned itself as the neutral asset to link them all. So what happens when the switch flips? Imagine $1 trillion flowing daily through systems that touch XRP. Imagine ETFs pulling coins out of circulation permanently. Imagine banks using XRP as the default bridge currency because it's faster, cheaper, and more liquid than anything else. At that moment, the price doesn't climb gradually, it resets overnight. From the perspective of retail investors, it will feel impossible, like waking up in a new reality. And that's the part most won't be ready for. They'll look back and realize the signs were there all along. Shrinking exchange supply, institutional accumulation, regulatory frameworks sliding into place, liquidity cycles turning. The map was clear, but only a small fraction of holders will have stayed seated when the music stopped. So here's the closing punchline. Don't mistake the current calm for safety. The silence before the storm is the most deceptive phase of all. While most are lulled to sleep by sideways charts and fading headlines, the system is rewiring in the background. The moment the liquidity cycle collides with structural adoption, XRP won't just move, it will reprice into an entirely new league. And when that happens, retail won't have time to react. The question is simple. When that reset arrives, will you be one of the few still holding the asset built to settle the world's value flows? Or will you watch from the sidelines as institutions lock the doors and name the new price? Like, comment, and subscribe for more content like this.